Good morning, everyone, and welcome to the latest in our series of Skybound Capital webinars, in which we'll be turning our attention back to the company's flagship fund, the Prism Income Fund, which this month records its 11th year of live track record. Many of you registered today will recall the Prism Fund webinar in April, less than a month after the hard lockdown had been declared in South Africa, and the world was gripped by a sense of almost paralyzing uncertainty. At that time, the Prism team gave a detailed overview of what its investment approach would be. It would be cautious, circumspect, more aware of the importance of managing liquidity and counterparty relationships within the fund. They also reported on the hugely detailed audit that had been completed on the fund for the 2019 year, and that the fund was given a clean bill of health. With 4 months having passed since that last update, various questions have been received via Skybound's global offices around things like performance, liquidity, diversification, provisioning, and future strategy of the fund as it enters its 12th year. Today's webinar will address those questions, as well as talk to the ongoing relevance of private debt as an asset class in portfolio construction. I'm joined by Conrad Amm, Skybound Capital Director, Devon Ollender, Head of Operations for the Prism Fund, Theodore Shou, Chief Investment Officer for Skybound Capital, Jabir Sardharwalla, Chief Strategist for the group, and Senior Fund Analysts Nyaradzo, Chitsike, and Siegmund, Thetard. We're also joined by Skybound Group Chairman Cliff Warren and Head of HR Kate Mapham, and our thanks to Ross Muller, who is doing all the technical things in the background. So we hope you will enjoy the next hour in discussion with us. And I'm going to start with Conrad. And I think the obvious place to start, Conrad, since we last did an update 4 months ago, how has the Prism suite of funds been doing over these past 4 months?
Thank you, Matt, and welcome to all our participants. I think we've got people calling in from Switzerland, the UK, Europe, Australia, Botswana, different parts of Asia, Africa, so a full house this morning and this afternoon for some of our participants. Welcome to all of you. The Skybound Group has continued to cautiously grow through the COVID period. Our group assets under management approaching the $2 billion mark. We now have over 100 employees in the group, and more than half of those employees are investment professionals. The Prism suite of funds have continued to deliver positive monthly returns. Ross, maybe if you could just pop up the screen. And here you can see this is the US dollar class track record. Since the COVID crisis hit in March, we've delivered a 0.64, a 0.3 in April, a 0.39 in May, and 0.46% positive return for the months during this crisis, taking our half-year return in the Prism US dollar class up to 3%. And on a rolling 12-month basis, the US dollar class has delivered 7.1% return net of fees to investors. The other classes, we have a sterling class that has delivered a positive 2.3% return for the first 6 months of 2020 to the end of June. And on a rolling 12-month basis, it's up 5.2%. Our euro class is also positive year to date for the first 6 months, up 1.5%. And on a rolling 12-month basis, we're up 3.5% from June to June 20. Over the past 3 years, all the currency classes in the Prism suite of funds have delivered positive returns ranging from between plus 5% per annum to plus 8% per annum. And I think you could see from that first table that the returns have been very uncorrelated to traditional asset classes like equities, bonds, and even various alternative investment asset classes.
And Conrad, perhaps you could follow that on by giving us a picture of subscriptions and redemptions, AUM changes during 2020.
Yes, sure, Matt. Ross, maybe if you could just bring up that screen. Here you can see the growth in the AUM of the Prism Fund suite. I've gone back 3 years when we had about $230 million in assets under management. We now have about $470 million in assets under management in the Prism suite of funds, down about 2 to 3% from December. So holding up very nicely, and you can see even during the 2018 period, we had a flat area there of AUM growth. So the assets have more than doubled over the past 3 years now in the Prism suite of funds. Just to give you an idea, thanks Ross, to give you an idea of flows on subscriptions and redemptions, the 2019 calendar year, we had about $10 million of assets coming in, about $4 or $5 million leaving on a monthly basis. For the first 6 months of this year, we've had positive subscriptions flowing in at about $5.5 million a month, and we've had about $9 million of redemptions on a monthly basis for the first 6 months of the year. Very pleased to announce that for trade date 1 August, we had some really big flows coming through. Almost $10 million came into the fund, and we only had about $3.5 million leaving, so a very good positive $6.3 million of net subscriptions coming in to the fund on the 1st of August. I think, this asset class, the private debt environment, has been tested. Not only private debt, I think some real estate funds have been really tested during the COVID-19 crisis that we've experienced, and a couple of funds have gated, they've suspended pricing and redemptions. The Prism Fund has continued to remain open and meet all liquidity requirements from our clients in terms of redemptions. And I think there are a couple of key factors for our success here, and I'm just going to run through a few of them because there are many that we can talk about. As Matt mentioned, I think the 11-year track record has made a huge difference, and we've got a steady client base within this portfolio. Our uncorrelated returns, even during a stressful environment like we're experiencing now, have stood us in very good stead. Our geographic diversification, and Ross, maybe you can bring up the graph to highlight this. Here we go. That gives you a quick snapshot of where the Prism Fund is positioned geographically, with the UK making up 30% of the investments, Europe now around 22%, Africa 20%, when Africa was originally 100% of the fund when we launched 11 years ago, America and Australia around 9%, the rest of the world and Greater China making up 9%. So a very well diversified portfolio indeed. There's also a lot of sector diversification, and Siegmund is going to address that later on in the presentation. I think another key factor to bear in mind is the carefully managed loan maturity profile of the Prism Fund. And I'll go into more detail when we look at our liquidity profile. But we have debt maturing on a regular monthly basis and not big tranches maturing at sort of half year or calendar year ends. We have an incredibly diversified client base within the Prism suite of funds. And Ross, if you wouldn't mind just calling up that pie chart. There we go. You can see that the family office client makes up about $100 million of the total suite, 21%. Funds invested into the Prism suite, about 23%, $108 million. Institutional investors make up about $66 million, about 14%. And then high net worth investors, almost $200 million, 42% of the fund. And I think it's important to point out that a lot of those high net worth investors and some of the family office clients have been clients of Skybound Capital for 10, 15 years, very well known to Cliff and I and the greater Skybound team. I think the other very important factor is the meticulously run treasury function within the Prism suite of funds. We have a team of people, CFAs, dedicated to helping manage this treasury function, which looks at cash management, maturing debt, subscriptions, redemptions, and counterparty liquidity requirements. The team that sits behind the Prism Fund is crucial to the success of the fund. I mean, we've just earlier this year employed another chartered accountant to join the team, taking our professional investment team in the Prism suite to over 10 people spread across accounts, legal, engineering, CFAs, and other investment professionals. I guess a key function of the Prism suite is our ongoing due diligence process. And I know that people aren't able to fly around the world anymore, but let me tell you, Zoom has taken control of our lives. and we are on Zoom all day, every day, just about, or telephone calls or Skype calls. So the team has really kept in touch with the various counterparties, not only looking at the past in terms of management accounts, but looking forward, attending board meetings, looking at the strategies, the COVID strategies that our counterparties are implementing. And that has been really key to our success. And I think the team will discuss that in a little more detail.
Now, Conrad, I think that's a good time to bring in Devon as head of operations to perhaps just give a little bit of colour to the extent of that due diligence. Devon, before I do that, can we just cover off a question from Bobby on the Q&A function on Zoom, who's just asking about the July numbers, which I do know you have available.
Sure. So in terms of the Prism US dollar class, that did 0.38% for the month of July. The pound class did 0.27 and the euro class did 0.22.
Great, thanks, Devon. Now, if we can just get back to that, focusing on the due diligence process and just giving some specific example around that and how extensive it is.
Thanks, Matt. And I think the key to the success of the track record for the Prism Fund is strongly built around the relationships that we've been able to develop with a lot of our counterparty relationships. One particular relationship operating out of East Africa, we had throughout the COVID process, we had complete visibility on the underlying loan book of that particular portfolio, as well as the strategies that were implemented in order to mitigate any risk from a credit underwriting perspective that helped sort of manage that loan book throughout the COVID process. What that meant is that through tighter underwriting criteria, there was a lot more liquidity that came back into the system, and we were able then to discuss a mechanism by which the guys were able to move the cash back to us and ultimately protect each of the books in both certain circumstances. Another key relationship would be a strategic relationship operating out of the UK and Europe. What the guys are starting to see on the ground now is an uptick in good quality deal flow with strong covenants and very manageable LTVs. The guys, through their professional networks and relationships on the ground, are able to ultimately diligence, and through the service providers are able to turn the deals around quite quickly and ultimately close on them, which gives us a lot of comfort in their ability to move and negotiate in the current environment.
Thanks, Devon. We're going to be talking to you a little bit later on. I'm going to go back to Conrad on portfolio diversification. Because when the Prism Fund started 11 years ago, it was very focused in a particular geography. Siegmund is going to talk about geography and sector diversity in just a moment. But perhaps you can talk to us, Conrad, about things like average loan sizes, counterparties, etc.
Thanks, Matt. Yeah, I'll give you a very high-level overview. We now have about 130 loans in the Prism suite of funds. The average loan sizes are sitting at about $3.3 million. This has actually come down from $3.7 million in December 19. The number of counterparties, which are basically businesses that we provide debt funding to, sit at around 52. These were sitting at around 53 as at 31 December 19. Our weighted average loan duration on the book is now sitting at around 508 days, give or take 16 months. This has come down from 538 days as at December 19. Our gross interest rate ranges still somewhere between 8 to 14%. Over the last few years, there has been some pressure on the sort of upper end of those rates coming down. But I think we are starting to see some really interesting opportunities arise in this COVID crisis. And we may see those yields being achieved again in the next 12 to 24 months within the Prism portfolio. The weighted average interest rate, if I can call it that, net of withholding taxes, probably sits around 10.2% currently on the portfolio.
Thank you, Conrad. Siegmund, I'm going to come to you now. We've mentioned how the fund started its life with a very specific focus in both sector and geography. But as it grew its track record, it sought other opportunities on other continents and also across a variety of sectors. And I'm just going to come to you for a picture of what that diversity now looks like 11 years into the fund's life cycle.
Thank you very much, Matt. Just to contextualize the Prism Fund, for the first 4 years of its life, it was very focused on African government payroll counterparties. And Devin has spoken briefly about one of these counterparties just before me. The fund still has a core allocation of capital to these original counterparties, but over time we have added sectors such as real estate, IT, SME funding, and manufacturing concerns to our portfolio. And these are spread across Australia, Europe, the UK, and USA. The following slides reflects the diversity of the portfolio at the moment, as well as the depth of the portfolio that we have built up over time. If you look at it on an industry sector split across regions, you can see that from December to June, it hasn't really moved much. But there are 3 points that I just need to note here. Firstly, in March, we did pre-COVID, so during January and February, we did some allocations into the IT and consumer staples sector, and in the UK and USA to fund further growth and acquisitions. Post-COVID, so from March onwards, as Damon mentioned, the credit criteria of all our consumer finance and government payroll counterparties was tightened, and they were able to return capital to the fund, which we were very happy with. And lastly, maturing capital in real estate in the UK was rolled into further opportunities identified in that sector in the UK as well. Ross, the next slide. If you look at the loan duration in the fund, as Conrad has mentioned, this has come down, but there are just two exceptions to this, and that is the UK and USA. The UK is largely because of the real estate sector, where we rolled into new opportunities. In the USA, we had an opportunity to write into a 3-year note that was senior secured with a cover on our loan of about 1.5 to 2 times of security. So we were quite happy to write into that. Otherwise, the duration of the fund has shortened as the loans have approached their maturity dates. Similarly, with the top 10 holdings, nothing much has really changed. There are some minor movements due to exchange rate fluctuations, or where we have previously agreed to allocated capital, and you'll see that these positions might shuffle around a little bit, but largely these are core allocations within the fund that we are building up. Just to mention, the largest holding in the fund that has been with the fund since inception and is a tremendous success story for the fund. It is now attracting capital from DFIs and larger institutions as well, at funding rates that are much cheaper than what we have. So what we have done is, and we have recognized that this will happen, we have started putting in place the building blocks of the future by diversifying into other sectors, as you can see in the top 10. In summary, the Prism Fund has matured over the last 6 or 7 years, and the team is now focused on the current counterparties and their success in these challenging times.
Thank you, Sieg. Conrad, you touched on liquidity in one of your earlier statements, and I'd like you to go into a little bit more detail in terms of how the fund has managed liquidity during a very trying time for fund managers across the globe over the last 4 to 5 months, and then also how you plan to do that looking into the future.
Thanks, Matt. Ross, if you could pull up that slide. So here you can see this is our 12-month liquidity forecast from June 2020 through to June 21. Just to highlight the light blue color there, that is our maturing debt schedule. And as I mentioned earlier, Matt, this is very spread out, and it's purposefully built like this to allow us to access liquidity throughout the year for investors who need to redeem. We have, on average, I'd say around $12 to $13 million of debt maturing on a regular monthly basis as a result. The red lines, the red bars there are cash. We're looking to build up the cash in the portfolio. As we mentioned, I think 4 months ago in our first Prism webinar, cash is king, and we're building cash in the portfolio to take advantage of future opportunities that we're starting to see, and that'll build up to between 4 to 6% of the Prism suite of funds. That's the red bars. The gray bars that you can see there, that's taking a look at the interest income coming through on debt and typically most of it comes through on a quarterly or half-yearly basis. But if you take a look on a quarterly, it's probably around $12 to $13 million coming through into the portfolio in terms of interest income on a quarterly basis. So a significant amount of funds coming into the portfolio. Also, if you might have seen the next couple of months, we've got quite a lot of maturity taking place on our debt, and probably that makes up 10 to 12% of the Prism suite of funds. So there's a lot of liquidity around in the portfolio. Liquidity is also driven by continuous contact with the counterparties that we deal with, looking at their balance sheets, looking at their cash flow requirements, and staying on top of that with our partners.
And Conrad, investment strategies during COVID-19 and looking into the future. We often say that the only certainty is uncertainty at the moment, and that provides a philosophical challenge for fund managers. How are you approaching it?
Exactly, Matt. Look, we launched the fund after the GFC, the global financial crisis, 10, 11 years ago. We're now in a COVID crisis, which is more, I guess, government-induced. It's a different type of crisis, but we're building cash reserves. It's important to have cash on hand to take advantage of opportunities. We remain cautious and committed to our existing counterparties. There's a long road ahead. I mean, this could take years. We're very aware of changing consumer behaviors. I mean, everyone's working on technology, on Zoom. Businesses have changed, they've pivoted. We have to be very aware of government support programs, which can't last forever. Government can't keep funding JobKeeper relief or furlong. A lot of these programs will run out next year. We need to reduce our exposure, and we are reducing our exposure to certain market sectors and pivoting and supporting our businesses that are seeing new growth opportunities in technology, in PPE. We've had manufacturers pivoting into that, and we need to support them and grow with them because there's incredible opportunities. We're also looking to continually improve the risk-return profile of the fund. There are going to be amazing opportunities that we're going to see over the next 12 to 24 months, and we need to pivot into those where we can take on board higher yields, but at the same level of risk, or even getting better security on board in the Prism Fund. I think finally, just to stay in very close contact with our counterparties, and also to make provisions where necessary. And you've seen that in the numbers we have been providing. I think this leads nicely into our next panelist.
It does indeed. Nyaradzo, Chitsike, I'm going to bring you in. At the last Prism webinar, you reported on the audit that had taken place, and perhaps the most substantial and detailed audit ever for the fund, which had an excellent outcome. But Conrad brings up provisioning, and I know you take advice and guidance from the auditors in this regard, but you've had a very special set of circumstances in which to operate. And if you could give us some more detail on provisioning strategy.
Thank you, Matt, and morning, everyone. So just to recap, so the fund is accounted in accordance with IFRS. IFRS 9 in particular is the standard applicable to the valuation of debt instruments that make up the Prism Fund. Now, this standard requires you to make an estimate of impairments you may face in the future. In applying the provisioning requirements of IFRS 9, we look at the valuation of our security compared to our loan exposure, as well as make an estimate regarding the probability of future default. Now, to assess and reduce the probability of default, we ensure that we are in constant communication with the management of our counterparties, reviewing their financial accounts on a regular basis, as well as monitoring key performance metrics. As noted earlier, we do have board representation on some counterparties, so we have full access and oversight of the operations of the counterparty, giving us a very good handle on their financial position. Now, regarding the valuation of our security, we perform our own independent valuations over the security we hold and make use of best practice industry accepted valuation techniques to determine these. In addition, we also receive confirmations of the security from our counterparties, who are themselves subjected to external independent audits. Now, we have made a conscious decision to take a more conservative view with regard to our valuations, and this is in response to the future economic uncertainty as a result of the coronavirus, which remains. As a result, since the onset of COVID, you'll note that our monthly performance has been softer compared to pre-COVID periods, and this is due to the provisioning that we have been applying within the fund. Now, our provisioning process has been reviewed by Deloitte as part of their year-end audit, and they were comfortable with our methodology. But further, on a monthly basis, the pricing of the fund is performed by Apex, who are the newly appointed third-party independent administrator of the fund. As we continue to apply our methodology, we remain confident that our capital remains secure.
Thank you, Nyaradzo. Devin, I'd like to come back to you there as head of operations. You know, Nyaradzo brought in Apex at the end there. I guess for all fund managers, independent oversight and administration is absolutely vital. And if you could just give us a little bit more detail on this new development with Apex.
We took a decision late last year to move away from the existing administrator to Apex. We felt that Apex had a bigger global footprint, and we quite liked the service offering, operating in the various jurisdictions, and the depth of the team and the caliber of the work that the guys perform. It's been a rather seamless transition throughout this process, which showcases their sort of global quality of work that they've put out into the market. On a monthly basis, there's a post-mortem that does take place. So ultimately, anything that happens during the month, we review it to try and get more efficient in the sort of timing and the delivery of the NAVs. But so far, so good. We're very happy with the team and the skill set that is currently employed within the reporting. We're also working with the various jurisdictions in the onboarding, when the continuous onboarding in terms of where we're looking to move into the next jurisdiction. So far, so good. I'm very happy to report that it's been a good onboarding process thus far.
Thank you, Devin. So that gives us a sort of operational review of the last few months and a slight look into the future. We're going to move now to our Chief Investment Officer and our Chief Strategist. Theo is sitting in China at the moment. Jabir is in London. And Theo, perhaps you could pick up on some of what Conrad talked about, opportunities looking ahead into the future for the fund.
When we talk about the outlook for the rest of the year, I don't think we can get around COVID-19. Fortunately, the virus is no longer unknown or even scary to most people, but it still affects every aspect of our daily lives, particularly the economy. Therefore, all of our outlooks take into account COVID-19. And I would like to highlight 3 key points here. First of all, the opportunities that we see in the market despite COVID-19. As our colleagues have just discussed, we did a lot of work in the first half in view of the pandemic, including rebalancing our portfolio, retreating from certain sectors and counterparties that might be negatively impacted, and more importantly, working towards building pipeline of investment opportunities that are either neutral or positive in a COVID-19 environment. Although we strive to remain very cautious, we expect more allocation to such opportunities in the near future, which should benefit the portfolio in the medium term. It is sometimes dangerous to generalize the market because one might miss the real gems. Let's use properties as an example. I just saw questions in the Q&A session. Some investors are really concerned about property valuation could go down, which might affect security of some loans. That is very true, that market valuation can always change. But as asset managers, our job is to make sure we set a loan to value level that provides sufficient buffer and comfort so that our loans are secured. More importantly, not all properties are born equal. For example, data centers are now thriving at the moment in this new environment. Even within hospitality, which many people think are heavily hit in this pandemic, we have seen many accommodations being fully booked by essential workers, whereas other hotels are entirely empty. So we build in all these COVID-19 considerations in our investment process, in our future investment process, instead of simply turning away from any investment. Our efforts of adjusting the portfolio doesn't confine to just looking for new opportunities. We actually also help our existing counterparties who remain in the portfolio. We have made such great efforts to assist them switch their business model or strategic focus to accommodate to the new environment. For example, we have funded new capex of manufacturers switching from producing ordinary products to personal protection equipments, the PPE that Conrad just mentioned. And let me show you a real life example. So this was a manufacturer counterparty in our portfolio. And on this graph, you can see the products that they used to produce, and that was their bread and butter. But now, the face shield, together with many other PPE equipments, have become the new key product of that business. That's just one example. And we have, in the consumer finance industry, for example, we have done so much research together with our counterparties, trying to help them optimize the future target prospective borrower to make sure that such new lending or new loan origination will potentially be exposed to less credit risk considering COVID-19. Overall, private credit fundraising is on pace for its slowest year in the past maybe 5-6 years, which is good news to us because the private credit market in the recent past was featured with overflooding of capital and very skilled risk pricing due to abundance of money. With more competitors now on a contraction mode, we are more optimistic that pricing of credit risk is going to be more reasonable, and this is beneficial for this asset class. The second key highlights is what will we do for the rest of the year? We will continue to apply our COVID-19 ongoing due diligence by engaging with our counterparties very closely. As our colleagues have mentioned, that we do con calls, we do Zoom calls with them every day. However, we are no longer separating reporting to our investors on COVID-19 alone, because now we have normalized our investment process taking into account COVID-19. The one way we stay away or be different from many of our peers or other lenders is that Skybound is not just a capital provider. Skybound is a partner to many of our counterparties. The research assistance that we can provide, the guidance, the advice that we can provide to our counterparties is very much leveraging our other business expertise. As many of our investors know, in addition to private credit, we are also thriving in private credit, in private equity, real estate, and public securities. Our enlarged investment professional teams have such synergy to provide to our counterparties in the private credit space. We have also exhibited very good liquidity, as Conrad and the team have already shown you. This enables us to be nimble. All the repaid principal and interest enable us to swiftly move to other investment opportunities. A recessionary environment calls for discipline. And we are proud to say that we are never in lack of discipline. Discipline is evident in our capability of limiting deployment in frothy market like early this year, sticking to the covenants, maintaining required loan to value levels. We expect slightly more deployment for the rest of the year, more selective in allocation with the same disciplines, and possibly slightly better returns if cash drag is to diminish and provisioning is nearing its end. Last but not least, what will we not do? The fund is not designed to focus on many distressed investment or special situation deals. We do have other vehicles and funds that target such strategies. Therefore, for Prism, it's not going to deviate from its long-lasting strategies to just take advantage of what we see popular in the market. With that said, the fund, we believe, will still benefit from the good market environment. We expect some of our counterparties to take advantage of this distressed situation of their competitors. We will not be surprised to see many mergers and acquisitions within consumer lending and SME lending space. We are ready to support some of these transactions if we are comfortable with the risk return profile and confident our counterparty have great free cash flow to repay. So in summary, we are still cautiously optimistic about the rest of the year, that we will see new opportunities, but we will remain cautious.
Yeah, thank you, Theo. I think recurring themes here are discipline and due diligence. And I'm going to now go to our chief strategist, Jabir Sardharwalla. Jabir always gives us a wonderful macro view of the world. He's thematic in his approach. And Jabir, some thoughts on the asset class in building a portfolio that is diversified and balanced.
Sure, yeah, thanks, Matt. And good morning, afternoon, evening to everybody, wherever you are. I'm just going to share my screen with you. Right, so it's an interesting asset class, private debt market, because I think there's still a bit of a mystery around it. It's growing almost in a stealth manner. And I particularly like this chart because it's growing at the expense of banks who frankly are failing for a variety of reasons. More recently, post global financial crisis in 2008, because of regulatory capital constraints, capital adequacy and all this kind of stuff. There's a lot of regulation now around banks, and as a result, it's affecting their cost base. They can't look at smaller loan sizes like they used to. That interpersonal nature that once had, it's all going out of the window. And who's benefiting from this? It's actually the private debt market. And that graph, which is almost symmetrical, shows the dark blue line, which is basically banks and securities firms, declining in their overall presence in this space. And at their expense, who's growing? The light blue line, the non-banks, the institutional investors and finance companies. Finance companies basically like us. And if you look at the underlying reasons driving the reduced lending, basically, it's giving rise to a deleveraging scenario for banks, whereby they have to shed what they have on their books because it's affecting their tier 1 capital requirements. Meanwhile, on the other side, on the demand side, you have an increasing appetite for yield in what has been undoubtedly an ultra low interest rate world since 2008. I mean, that's a long period. It's a really long period. And then on top of that, if you look at demographics, the world's population is now approaching 8 billion. 8 billion. And if you look at life expectancies, generally speaking, 73 years of age. For women, it's about 76. For men, it's about 71. But what's even more interesting are those aged over 50. And just quickly, just some regional stats. Oceania, nearly 30% of their population is over 50. North America, 36%. Europe, a staggering 40% over 50. LATAM, nearly a quarter. Asia, a quarter. The youngest population, believe it or not, is Africa at 11%. So this over 50 brigade, which is now growing and growing, is clearly leading to a demand for yield. It's a real balance sheet issue. And that gives rise to the need for consistent income and also a certain predictability around that income. And against that, people have to calculate how much they're willing to sacrifice in terms of liquidity in order to deal with the real issue of negative real rates that we have in the world today, and the potential for inflation coming up, I believe. I mean, it's in the system already. It's just quite low at the moment. But I believe it's going to grow by year end, and it's going to really take off into next year. So that's the background to the private debt market. And if we go on to the next slide, which looks at the total private debt market to date. So this is global private debt assets under management. It's risen very sharply, and this is what I mean by that sort of stealth approach. Today, you're looking at a total size of around 850 billion. So, just approaching a trillion. There are something like 480 odd funds out there that serve this entire sector across those different strategies. Direct lending makes up approximately half of all those funds, nearly half. And if you look at the geography concentration, it's actually quite alarming. North America accounts for 500 billion almost out of that 850 billion. 500 billion in North America. Europe, another 240 or so billion. So there's the lion's share. Then Asia is a much, much smaller 57 billion. And then the rest of the world, which is basically Africa, LATAM, and Eastern Europe, is a mere 23 billion. So you can see it's a very distorted spread. There was a recent poll done by the same source of that graph, Preqin, and they asked people what they felt the key challenges were ahead. And the questions went out to several thousand individual entities across investors and fund managers. And interestingly, 40 to 50% of them in both categories replied that asset valuations and competition for assets were the top priorities. A further 27% of investors said that rising rates was a real concern. By contrast, only 2% of fund managers thought it was a concern. I thought that disparity was particularly interesting. And then 25 to 35% of those surveyed said that geopolitics and deal flow was a major concern for them. If you look at the global dry powder, i.e. cash, it's been growing for some considerable period of time. And there was a dip towards the end of last year. That's largely because of the tensions that started to arise again. And it did dip again in Q1 of this year, and then it started to pick up. But it just shows the amount of cash that's still sitting around as part of that overall 850 billion. The figure actually comes to 270 billion in dry powder. That's nearly a third of total assets. And part of the reason is clear because there's a higher build-up because of COVID. But the other problem here is size. Over 65% of funds are in excess of $1 billion. So there's an allocation issue here. Only 4% are actually under $250 million. So really big spread across them. They are struggling to deploy the cash across good ideas. So there's an opportunity set here that goes to what my colleagues were saying earlier. If you pick your sweet spot, there is room for improvement. These large funds are going for the bigger ticket items. But in order to snap up those opportunities, you've got to plant the seeds somewhere and you've got to catch those seeds. And that's the opportunity that we're effectively seeing. So where are we in the cycle? This is a critical starting point for any asset allocation decision-making process. All curves are different. I could show you the all familiar sine curve, which makes out that the world is totally predictable. There's another curve, which I think is a little bit better. And at any point on the curve, if you were to do a blow up there and see how it looks, it would be all over the place. So there is no one curve that defines everything. But I think these broad definitions here, the different stages, are quite relevant. And where are we in this process? I think we are definitely in the contraction phase, in what has been a COVID-induced recession. If you were to draw a timeline at the bottom here, then starting here, you would have basically 2008, because that's where life began. And it's just shortly after that that the Prism Fund began. So that was the beginning of our life cycle. And then if you run across, you suddenly hit this incredibly low rate period, which has persisted all the way through, right to about here, where we had the COVID saga, particularly in China. And then obviously it hit the rest of the world about a quarter later. And that exacerbated the whole low rates environment. And then we come to about here, which is August of this year. And I would say roughly that's where we are. Where we go from here is really critical in terms of the asset allocation question, because we either persist with low rates, in which case private debt will absolutely continue to provide outsized returns. The other thing is that we start to hit inflation. And if we hit inflation, there are two possible outcomes: positive real rates or negative real rates. If it's negative real rates, then private debt becomes even more attractive. If it's positive real rates, then private debt has to deal, like any other asset class, with the issue of outsized returns to compensate you for inflation. And I'm going to discuss later exactly the mechanisms that exist in Prism today to deal with that issue. In the same survey, 62% of investors felt that the market has peaked. Contrast that with 48% of fund managers. 5% of investors say that we're in a recession. By contrast, 9% of fund managers think we're in a recession. And 11% each say that we're still in a recovery expansion. Might sound strange, but they're saying this is a COVID external exogenous event. Therefore, it hasn't derailed the original path. They may or may not be right. So what I'm doing here is just to compare the returns of different asset classes. This is a very nice chart. It actually takes quite a range of different assets here. And it looks at performance, the compound return. Don't worry with the average return. That's just an arithmetic return. It's misleading. And then the annualized risk. And it measures it over the period of 10 years to Q1 of this year. So obviously some of these categories here will have gone up a bit, but not massively to distort the overall picture of what I'm trying to portray here. If you go down to the very bottom, you've got CPI, inflation, which over that same period is averaged just shy of 2% with a volatility of just over 2%. So that's a critical indicator there. And then in the middle, roughly, or just below middle, you've got private debt here. UL stands for unleveraged. And that has delivered almost 7% per annum over this 10-year period with a volatility of 6%. Now you contrast that with the liquid markets, where they range from about 6.5% to 7%, but with considerably more volatility. And Prism would sit within this definition of private debt here. So on the right, I've simply taken a snapshot here from one of our latest fact sheets to show how Prism compares. And it has, since its 11-year history, it actually has delivered just slightly shy of 8% per annum. but with volatility for the dollar class of 0.3 to 0.4%. It's a pretty staggering return. When you contrast that volatility with the volatility of private debt, this is really how to compare different asset classes. Get them all on an equal footing first. It's very important. Otherwise, you can't compare and contrast fairly. You're literally comparing apples with bananas. The question that we get quite often is, how is it that your fund has delivered such steady, consistent returns with such remarkably low volatility? Well, it's a debt fund. And as a debt product, and as I'll show you later, we are giving out loans which are fixed for about 12 to 24 months. So there is a predictability that comes into this. So what we're earning every month is the coupon, minus any defaults, which to date have been 0, and then allowing for any cash balances. That actually gives you your volatility, because it all depends on cash flows, and therefore it affects the denominator base. If you were to look at the sterling and the euro classes, you'll find that the volatility etches up a bit, simply because there's a hedging cost. We don't take any currency risk at the share class level. We hedge it out, but there is a cost attached to that hedging. So that impacts the volatility too. So you'll find that for the euro class, the volatility jumps to about 0.7, 0.8, but still dramatically less than the private debt category. So, you know, these are essentially what I'm trying to get across here, is that there is some considerable bang for your buck here, or what some would call value for money. If you take that previous chart and then just rejig this, what you have is the world of equity and the world of debt, split across public and private. And what I'm going to focus on here, just some of the key headings. So for instance, in terms of return profiles, being a debt fund, the main risk to the investor is obviously debt being written down. So here the investor would participate entirely in the downside. That's what happens in private debt. And the key, therefore, is to make sure that all the processes are as good as they can be. If you look at the investment holding period, it really ranges across all of those. But for the world of private, it can be, and usually is, very long term. You know, this is very much at the illiquid end. By contrast, Prism is not limited, because it's an open-ended vehicle. Therefore, under normal market conditions, liquidity is not an issue. My colleague Conrad just spoke about and speaking to that liquidity chart, how we manage the liquidity. And we always have something coming in. That's how we provide our liquidity. That's how we're able to offer the terms that we do under normal market conditions. So in general, liquidity for us is manageable. The other point here, which is absolutely key, is the level of control that we, the investor, have on our underlying investments, the investees. And it's significant. I mean, we run very high, extremely tight covenants, and we have detailed access to management information, often a board presence, always risk oversight. This is not the case with liquid and illiquid instruments across the board. Certainly not all the time. It really does vary. If we go on to the next one, this looks now just essentially at the world of debt. And as you go across from left to right, you'll find that the risk profile goes up. The reason for the solid black line in the middle here is that we don't cross over that line for the Prism Fund. Our focus is just on this side of the world of debt. So some of the strategies here, on the left here, amongst senior debt and mezzanine, the focus is certainly on capital preservation where senior debt is concerned, but you're going down the scale a little bit in the world of mezzanine. In terms of target returns, obviously senior debt comes at a lower coupon, but as you go up, it jumps. Now, if you look at Prism, we're able to cherry pick the kind of trades that we go for, provided we are always able to secure the debt. If we can't secure the debt, we won't touch it. So our definitions are focused on senior secured, junior, and mezzanine, all secured. It's really key to make that point. The return driver is obviously coupon based, all of it is. We do not use any leverage. This is not the case as you go up the scale. The senior secured gives us roughly 10 to 12%, and the other, the junior mezz, helps us to take it further to 13 to 15. Why is that important? Because if we're approaching a world of inflation, we've got to be able to make pace with inflation. And that's where we're able to get that additional kicker. It's very important. This is what we have to factor in going forward. The other key point here is in terms of the investment period. Our blended weighted average maturity is around 1.3 to 1.4 years. Now you contrast that with other products, it's considerably more. And that's another inflation benefit because it allows us to reset the fund sooner and sooner. And that's very important. Once inflation kicks in, we can reset the terms as the loans mature. The term of the fund, I've covered this. This is, it's monthly dealing. We're able to do this given the liquidity profile that we run. Look at the other strategies. It's vastly more. You are locked up. And in the process, you are exposed to management risk because over that period, there is nothing to stop the managers of a fund moving on and being snapped up by somebody else. It's like investing in a company and suddenly finding that the management has changed. And then you have to question what you want to do. Now, in the liquid markets, you can redeem. We consider ourselves to be reasonably liquid. If you're not happy with it, you can redeem. That's a risk mitigation tool. Competition, this is always an interesting one. In all my time, I've come across very, very limited competition in terms of what Prism does. And recently this was put to a test. I mean, a very reputable database contacted me and they were giving me a demonstration of the entire private debt and private equity space. And they said, what do you know about your competition? And I said, well, I don't think we have many. And they said, well, let's put it to the test. I'll demonstrate it to you. And so they put in factors like the liquidity terms, i.e. monthly dealing, the type of investments that we make by sector, the size of investments that we have, and the strategy, i.e. up here, direct lending. And when he hit return, it revealed 0 competitors for all those criteria. It kind of confirmed what I instinctively knew, but I was actually very pleasantly surprised. And the last point is the ability of our fund to influence the restructuring process. This essentially comes down to the issue of control. It varies across the strategies, but I honestly think typically it will dilute as you go across the chain. We have very close contact, and any of our clients who have dealt with us and who subject to NDAs have seen the detailed work that we do. I think you'll realize exactly just how much depth we go into, thanks to the Prism team. Last time, this was in the first webinar on the 21st of April. I spoke at length about the illiquidity risk premium. And so I thought I'd do an update on this just in terms of how things have fared. And I took the liquid markets on the right-hand side here. Here's the level that it was at on the 21st of April. And then here's where it is as of 24th. So that's almost yesterday's close. And there's been a move, not dramatic, but still against that context, it's quite significant. And you'll find that there's been a risk-off mood. But in the process, spreads have really collapsed. So this would suggest the opposite. Actually, a lot of it has to do with the level of support that's in the market. Remember, this is liquid. All of this represents the liquid markets. And just as a comparative, on the right-hand side, you have the global financial crisis of 2008/9. On the left here, you have the illiquidity risk premium. And by and large, that hasn't changed. It's still the same. So I just went through a calculation today, bearing in mind that last time I was coming up with a figure of around 12 to 16% illiquidity risk premium. So I just broke down the components. The forecast for inflation hasn't changed. It's saying 1%. I don't buy that, but that's what the market's telling you. So 1% for inflation. If you take the liquidity risk premium, that's a sort of a blend of these, then, but more out of the high yield sector, given that there's no liquidity, or there's much less liquidity, sorry, in the private debt space, you're looking at a premium of 4 to 5%. Then if you add the illiquidity risk premium, as shown by that graph here, for these three categories, all in the direct lending space, you can see it's around 150 to 300 basis points. But there's a word of caution here, and I mentioned this last time. This is heavily skewed to the larger companies. As you go down the scale, that illiquidity risk premium rises. It pretty much doubles. So I factored in another 3 to 6% there for the illiquidity risk premium. And then last but not least, the risk-free rate, which I've broadly taken as 1% here. When you add that up, you have a range of 9 to 13%. Now that's quite staggering in this day and age. So whether you believe the outlook is for continued low rates, indeed negative real rates, or you think the outlook is for inflation, that's quite a buffer and a very compelling case to be in the private debt space. That's the key message I wanted to bring from this particular slide. Sorry, it's a busy slide there. I'm not going to go through all the numbers. I just want to highlight one thing. What this is a correlation matrix. So any good portfolio should have something that will always compensate something else. And what these numbers are showing here is how things correlate to each other. So for instance, at the second line down, non-US developed equity markets, you'll see that has an 85% correlation to US stocks. Not surprising, to be honest, because US stocks do dominate world indices in the equity markets. So you'd expect that. And equities across the globe share fairly similar characteristics. So if you come down to the highlighted line there, private debt, and sorry, I know it's a bit small, but I'll read these out. I mean, fast forward to global equity, the general private debt unlevered universe is about 60% correlated. So that's considerably less already than some of these other classes. If you look at the world of investment grade corporate debt, it's about 20%, 0.19. Now that's interesting. That tells you that generally it's a cleaner class by its nature. The deals are targeted. They're looked after. There are good covenants in place around them. If you look at the world of 10-year treasury, that's exactly what you want to see. It's a negative correlation of 15%. Likewise against cash, and so on. If you go across there, you've got generally a lower correlation. So I asked my colleague in the Cape Town office just to run a similar metric comparing Prism to the general private debt universe. And what it revealed, basically, is this. First thing I'm going to go straight into is that we have a negative correlation to the direct lending index. So imagine you're building a portfolio and you need something to work for you. It's a little bit like the seesaw analogy. One side goes up, the other side goes down. But what you want is something just doing a little bit better than the other side that goes down. This is going to give you diversification. But look at the other correlations as well. It's actually quite startling. I mean, for the most part, it's negatively correlated against the equity indices. It's negatively correlated to gold. So if you're worried about inflation, again, an investment in private debt is something that's worth considering. The other point to note here is inflation-linked bonds. That's a very clear indication of the negative correlation that the Prism Fund has. If I was to summarize essentially the key points out of this, this is what I would have to say. First of all, you're looking at negative correlations to equities and bonds. That's significant. The number of roadshows I've been on in London where people look at our performance and they say, this is fantastic. I mean, we have the obligatory allocation to fixed income in the liquid space, and we find it's not really giving us the kind of hedge that we're looking for. Whereas Prism is doing just that. It's a cornerstone. It's giving you a backbone. Secondly, it clearly displays insignificant correlation to various macro factors, such as inflation. I stressed earlier that our share classes are FX hedged, and that's important. There is an independence to a low rate environment. We've demonstrated that in the 11-year cycle of the fund. It was born in the aftermath of the start of the global financial crisis. And here we are now, we've hit a recession. So you can argue that we've actually come to the end of the term. It even displays a negative correlation to the direct lending index. A lot of people might find that odd, but you have to remember the direct lending index is not only skewed to larger companies, but it also has an equity component built in. And therefore, there is a natural correlation to the equity markets. We don't have that. Ours is focused on debt. Here's, I would say, one of the single biggest attractions of the fund. It offers better monthly liquidity dealing. In this case, monthly dealing under normal market conditions. That's a very powerful factor. On a weighted average basis, we are able to protect inflation because we can reset the loans at a much earlier and sooner rate. And last but not least, perhaps the most important, there is due regard to the economic cycle. What I've done here, very lastly, is just a guideline to investing to any investor. Decide what your objectives are. Is it income? Is it capital growth? Is it a combination of the two? Or are you looking for a specific structure, for instance, tax mitigation? From there, ask yourself, what liquidity are you looking for? If you're looking for something that's less than a week, then stick with the listed world. Don't go anywhere else. But be careful. There have been recent cases where liquidity has been highly deceptive, even in the liquid world. We've seen the case with Neil Woodford and the catastrophe that's created. The most recent example are all those investors, particularly in the UK, £12.5 billion worth, locked up in property funds. And now in their infinite wisdom, the FCA has launched a consultation paper suggesting that investors now give 6 months notice period. So has the world of liquid suddenly morphed into illiquid? You know, this could be the first step. And it's not, and that's property related. It's not the only class. There's also the world of small caps. So be very careful what you're going into. If you can afford some degree of lockup, then think about your cash flow. Your timelines are absolutely vital. If you don't need it for the next few years, then think about opportunities outside of the world of liquid. Think about the cycle, bearing in mind what I said about where we are and the factors involved, interest rates, inflation, and so on. How active do you want to be? In terms of the product, what is it that you want your product to do for you? Are you looking for something that's niche or something that's more general? Who do you want to do it? Do you want to be active and select, or do you want the fund to do it? And most of all, does it give you non-correlation? Because that determines bang for your buck. Lastly, from an investor point of view, there are two investors here. There are those yourselves who invest in us, and then us who invest in our underlying investments. Think about the kind of relationship that you want access to. Are you able to gain access to the management team? What sort of reporting are you going to get? What kind of competition exists? And how good is the security and the collateral? And last but not least, the dealing terms. So I hope that's given you a flavor of what goes into it. It's the reason we call it the art of investing. There's a hell of a lot that goes into it. There are so many factors to take into account. And I hope that today's session has really demonstrated from so many individuals just how we go about operating.
Thank you, Jabir. Fascinating as always, and wonderful to see that. I know at the top of the hour we saw a couple of people obviously having to go to other commitments. I think we've proved in 2 webinars it's almost impossible to encapsulate all that we need to into 60 minutes, but always fascinating. There have been some questions coming in during the webinar. I'm going to mention Brian, Bobby, Carl, Tim. I know Theo has been diligently answering some of those questions already. Those we haven't got to during the course of the hour and 15 minutes or so, we will get back to you as we did with the last webinar on a personal basis. So thank you to all our panelists. It's been another fascinating session. I'm going to leave the final word to our chairman at Skybound Capital, Cliff Warren. Cliff, as you always say, the devil is in the detail.
Thank you, Matt, and thank you all for attending, and thank you especially to our panelists who form the core of our investment team, Conrad, Lee, Nyaradzo, Devon, to quite a few. Jabir, you continue to amaze me with your pearls of wisdom, and Theo in Shanghai. Thank you for all the work you put in. You worked tirelessly in the general and under very difficult circumstances. I know that it's been very trying circumstances not to be able to travel and to get to the counterparties or the investments that we invested. But thank you all. Thank you. Thank you, Matt.
Thank you, Cliff. I think a final word from Kate before we say our farewells, and encourage you always to stay in touch with our team. As I mentioned, we'll get to any Q&As that haven't been directly answered in the last hour. We will get to them, and please feel free to stay connected with the team. Kate.
Awesome. Thank you so much, Matt, and thank you so much, Cliff. It really is incredible to be part of a dynamic, focused, and strategic team. So thank you all for your input. And again, thank you so much. We had 151 participants. So thank you everyone from across the world for logging in and joining us. And again, if anyone has sort of missed a previous session or would like to sort of re-listen to this one, you can just go to the Skybound website and then just go click on the Media and Insights tab, and then all the talks and webinars are carefully in a library there. So please feel free to go in and have a look. But otherwise, have a wonderful rest of the week, and stay tuned for the next exciting episode. Thank you so much.